and welcome to the Global View on this Friday. Let's first get to the tweet of the day. This one from Sven Heinrich, better known as the Northman Trader, talking about, well, this is the beginning of November, saying, nice try bears, better luck next time in terms of the VIX. Now, just in the past couple of hours, as we round out November, of course, let's take a look at what he's saying here, saying the trendline rejections matter. Even on the VIX, you can argue about it or you can heed the message. Fact is, 2023, the VIX broke a multi-year uptrend to the downside, and any effort to recapture it has failed. All right, let's get across US consumer spending. It rose moderately in October with the core PCE price index up 0.2%, while annual increase in inflation was the smallest in 2.5 years. Inflation, as measured by the Personal Consumption Expenditures Price Index, unchanged in October after rising 0.4% in September, with food prices climbing 0.2%, energy falling more than 2.5%. For the 12 months to October, the PCE price index increasing 3%. And the US labour market gradually easing, with more Americans applying for unemployment benefits last week, and the number on the jobless roll surging to a 2-year high. Well, US Treasury yields climbed even as some investors saw the data as evidence the Fed could cease its interest rate hikes. The yield on the 10-year Treasury note up 7 basis points to 4.34%, but for the month it's down 53 basis points, its biggest monthly fall since 2011, and the 2-year rising to 4.7%. Meanwhile, New York Fed President John Williams has said in balancing the risks of too high inflation and a weaker economy, based on what I know now, my assessment is that we are at or near the peak level of target range for federal funds rate. And San Francisco Fed President Mary Daly is saying, I'm not thinking about rate cuts at all right now. I'm thinking about whether we have enough tightening in the system and are sufficiently restricted to restore price stability. Well, the US dollar was boosted by month-end buying despite reinforcement of expectations of a more dovish Fed. The Aussie trading at 66 US cents, and the euro was weakened after data showed Eurozone inflation slowed in November, more than forecast, to 2.4% year on year from 2.9% the previous month. All right, let's get across what we've seen at a macro level in the States and how that's likely to inform investment decisions. And Dave Sekera, Chief Market Strategist, joining us from Morningstar. Dave, great to catch up with you again. Thanks for joining us.
Good morning.
Let's then first start with that macro picture we're seeing right now, just off the back of, I guess, those latest numbers with the PCE core number there. Also, some maybe weakness emerging in the labour market. What's your view as to how the US economy is tracking right now?
Well, we had earlier numbers come out this week that the US GDP in the third quarter actually grew even faster than expected. It was up, 5.2%. But I talked to our economics team and they still noted that they think, a lot of the factors that really bumped it up that high are really one-time in nature. So we wouldn't read too much into that. Now, we're still in the soft landing camp. Our base case is still no recession. When I take a look at, the macros, the tight monetary policy, high interest rates, rising lending standards, that's all going to take their toll on the economy. So right now, our forecast for economic growth is we do expect that growth rate will slow sequentially each quarter, until the third quarter of 2024. So right now, we're looking for 1.7% here in the fourth quarter, falling to 1% rate in the first quarter of next year, falling just below 1% in the second quarter. Then by the third quarter, we're looking for the economy to get really just about a bit above stall speed at that point in time. And then we're looking for the reacceleration thereafter in the fourth quarter and going into 2025.
All right, so are you of the view then that the Fed is done? If so, when are you expecting it to begin cutting?
Yeah, so I think all the good news in this is that inflation has slowed, even in the face of a relatively hot economy. And we're looking at, inflation, our projection for next year for PCE, which is the Fed's preferred measure for inflation, of about 2% on average. So our opinion, and it's been our opinion since July, is, the Fed is done hiking. In fact, we think that combination of that slowing rate of economic growth, moderating inflation, that gives the Fed the room that it's going to need to start cutting interest rates, in the first half of next year. Our current forecast is that first cut might be in March of next year. So we're then looking for the federal funds rate to get cut several times over the course of next year, looking for it to end 2024 at about 4% and about 3% in 2025.
All right, given that backdrop, Dave, let's take a look at the equity market outlook. Now, you noting there that, of course, that Santa rally has come early this year, but the rally we've seen has been fairly broad-based.
It has, and when you look at the Magnificent Seven, that's certainly been the big story of this year. Six of those seven stocks we thought were significantly undervalued coming into this year. We think that's really played out at this point. Only Alphabet is still undervalued. The rest are all pretty fairly valued at this point. And Apple is one that we still rate with 2 stars. That's on the lower side. We think that's at about a 16%, premium to our fair value. And what we noted here in November is that rally, only 1/3 of it came from those Magnificent Seven stocks, as opposed to, 2/3 year to date attribution from those seven. So we're definitely seeing that, starting to spread out and broaden out into the rest of the market. And that's one of the themes that we think will extend, well into next year, into the value category, and down in capitalization into the small caps.
All right, so overall, Dave, how do you view the market valuation there?
Yeah, so after this rally, we've gone from what we considered to be at the end of October, pretty rare undervalued territory. I think the US market index, is up about 9% right now. So at this point, we're only at about 3%, below a composite of our fair values. I think the markets will probably be relatively quiet over the next couple weeks going into the year end. I think really probably the next major test of the market is going to be in February and March of next year. And of course, that's when companies will start giving, their earnings for the fourth quarter, but really my concern is going to be what the guidance is that they give for 2024. I think a lot of management teams are going to want to set expectations lower as they're also looking and seeing the economy slowing down. So I do think that the best position that we see for investors today is going to be overweight value stocks. When we look at the broad market, those are trading at about a 15% discount to our fair value. We'd market weight core or blend stocks. Those are the stocks that have some attributes of value, some attributes of growth, but don't necessarily fit on any one of those two categories. And growth stocks, as much as they're up, this past month, I think they were up, over 12%. They're now starting to get into overvalued territory. In our view, they're trading at about a 3% premium. So I do think that especially in like the technology sector, it's a lot of different areas that maybe investors should look, go ahead, start finding some of those stocks that are overvalued and overextended, and take some profits there. And as I mentioned, small cap stocks are also significantly undervalued. And I think next year is going to be a good year for those.
Well, that is good news for those in that small cap space, which of course suffered over the past couple of years. Dave, I see you point out here, particularly as far as the Magnificent Seven, you're saying one undervalued, one overvalued, the rest fair value. More broadly, when you're looking at the mega caps, which ones are you seeing as perhaps undervalued at this point?
Yeah, it's interesting, taking a look at what's going on, in that part of the space and really trying to figure out, what's going to drive the indices, next year. And I take a look at, which ones based on our valuations have the biggest ability to move the indices. Again, Alphabet, being one of the largest of the mega cap stocks is undervalued. Amazon's still undervalued. It's a 3-star stock, but it's, enough that it's large enough anyways that it can move the markets. Berkshire, Warren Buffett's, holding company is probably 10 to 11% undervalued. We think that that's got some upside next year. In the oil markets, we think both Exxon and Chevron, have upside potential. And then lastly, two others that I would highlight that have been, pretty beaten up by the markets here in the US, Verizon and Comcast, two, deep value stocks that we think have a good story going forward. We see a lot of upside potential in those two.
Now, Dave, just let's breaking it down sector by sector. You mentioned technology, but you're saying what overall here you're seeing the sector is overvalued by some 8%.
Exactly. So I do think technology, again, this has been a very volatile sector this year. There's been a number of different instances that we went from, overweight to market weight to underweight back to market weight. And at this point, I think with as much as it's run up technology, it's a good time to start underweighting that again. So a couple of stocks I would highlight there that we think are overvalued. There's Oracle. In fact, Oracle is probably one of the most overvalued stocks in our view under our coverage. It's a 1-star rated stock, trades at a 53% premium to our fair value. Apple, 2-star stock, that's up 46% year to date. So after that run, it's now at a 16% premium to our fair value. And the last one I'd highlight there is, IBM. I think IBM is just over the longer term, still kind of a no growth business, trades at a 24% premium to our fair value. depending on when you own it, you might have some embedded losses there that you can take and use those losses, to help offset some gains you have elsewhere.
Dave, energy in focus, of course, given we just had that
Yep.
OPEC Plus meeting with extending those cuts into next year, but perhaps less than expected. What's your outlook then
Yep.
in terms of the energy sector?
Yeah, it's become a lot more attractive. It's now trading at about an 8% discount to our fair value. We did think that it was overextended in the third quarter, but it's sold off to more reasonable levels. Among the exploration and production names, with the global majors, I'd highlight Exxon. That's a 4-star rated stock. Trades at a 16% discount to our fair value. Pays a pretty decent dividend at 3.7%. Among the independents, the two I'd highlight there are APA, formerly known, I think, as Apache, and Devon, both 4-star rated stocks, trade at 35 and 25% discounts, respectively. And that Devon, I think, has over a 7% dividend yield, certainly very attractive, in our minds. And then lastly, I still like the pipelines. We still see a number of different, very undervalued opportunities there. Equitrans would be one that I would highlight, trades at a 40% discount to our fair value, a 6.6% dividend yield.
Dave, let's focus on materials now. And I see you
Mhm.
point out with looking at lithium, of course, we
Yeah.
saw that run up 2022. This year, those prices have come way back. What's your
Yeah.
outlook for next year?
Yeah, I think this is a great example sometimes how the markets, act like a pendulum and they can just swing way too far in one direction, and lithium prices certainly ran up, too much last year. Now we think that they're running down to the downside, way too much as they've crashed here in 2023. So really our long-term view here, and it's going to be based on our view for, the electric vehicle market. And I think we've talked about this before, but by 2030, we think at least 2/3 of all global new auto production is going to be electrified, whether hybrid or battery electric. And when we look at the amount that's being mined for lithium right now, we bring into that, our projections for the amount of lithium that will come online over the course of the next decade. We just don't think that there's going to be enough supply for the amount of demand that's going to be out there. So again, we still see, long-term demand. So one stock here that I would highlight for investors, is going to be Albemarle. It's a 5-star rated stock. It's down enough now that trades at a 60% discount to our fair value. That's one that I think is probably one of the more stable, more established names in the lithium mining sector.
All right. And staying with commodities, gold, of course, also in focus at the moment, given the gold price is sitting comfortably above $2,000 an ounce. What opportunity are you seeing there?
Yeah, and gold I think is really interesting right now. So, we have a little bit more of a dour view on the long-term forecast for gold price. So in our models, we're actually looking at gold, dropping down, $1,865 US over the next 3 years and dropping even further to, 1740 in 2027. But yet, we think a lot of these stocks, even with those being our assumptions, are undervalued. So I think there's a lot of leverage in these stocks to the upside if gold, either remains here or moves, further. So the one I would highlight that we think is very undervalued is going to be Newmont Mining. It's a 4-star rated stock, trades at a 23% discount to our fair value, currently pays a 4% dividend yield.
Dave, almost out of time. Let's just round it out with retailers, of course, also in focus at the moment,
Yeah.
given we're in holiday shopping season. Last weekend, of course, we had Black
Mhm.
Friday, Cyber Monday. What's your outlook for that sector?
Yeah, I mean, as far as, the holiday sales, we're looking at a 3.2% increase in what we call modified retail sales. So essentially, we take the broad retail sales number, we strip out, some of those categories like autos, fuel, home building, and really just look for goods that are subject to those holiday sales. So we really think that this year, after being up 6% last year, we're just looking for like a same increase with inflation. But I do think that, there's a number of different ways to slice and dice it, a lot of different opportunities. In store, I think is going to be relatively flat. But as far as, online sales, we're looking for over a 9% increase there. One stock I would highlight, not necessarily really a holiday story, per se, but one stock that I think has just been overlooked by the market for a while now, and that's eBay. So I'd say, it's one to take a look at. It's a 4-star rated stock. It's a company we rate with a narrow economic moat, which means we do think it has, long-term durable competitive advantages, and it's at a 15% discount right now. They've got some good catalysts behind it with a new app that they've rolled out. So I do think that that's an interesting story in today's market.
Dave, terrific to get your strategy as usual. Thanks so much for joining us from Morningstar.
Well, thank you.
Okay, that is the global view. Stay with us. The Open, just a minute away.